What if two people started with the exact same $50,000, took completely different paths for 20 years, and still landed in almost the same place financially? One of them spends 2 decades fixing toilets and chasing tenants. The other never lifts a finger. One answers 2 a.m. phone calls about a broken water heater. The other doesn't even know what day the market went up or down. So who actually made the smarter move? Today, we're running the full 20-year math on 2 investing strategies: rental real estate and index fund investing. No hype, no bias, just the numbers. By the end of this video, you'll know exactly where the real estate math quietly falls apart in the early years, why both strategies can end up producing almost identical net worth after 20 years, despite looking nothing alike along the way, and which specific advantages, leverage, tax shelters, liquidity, scalability actually matter for your situation. You'll also see the exact moment gross rent and real profit split apart on paper, and why so many first-time landlords never notice the gap until it's already cost them thousands. Let's meet our 2 investors. Jake went the real estate route. He took his $50,000 and used it as a 20% down payment on a $250,000 property. Right away, he's holding something real, an asset 5 times the size of his actual cash, thanks to leverage. Marcus went a different way. He took the same $50,000 and dropped it straight into a total stock market index fund, then kept feeding it $300 every month after that. 2 men, same starting number, 2 completely different relationships with their money from day one. In the beginning, Jake feels like he's winning. He owns something you can touch. Every month, a rent check lands in his account, and there's a certain pride in that, a physical asset with his name on the title. He walks past the property sometimes just to look at it. He tells his friends about it at dinner. It feels like proof that he's doing something with his life. Marcus, on the other hand, just watches a number slowly move on a screen. Not much of a story there, at least not yet. There's no property to walk past, no tenant to wave to, nothing to point at and say that's mine. Just a login page and a number that changes by a few dollars a day. But this is exactly where the gap between feeling and reality opens up. Jake did his math on a napkin. Rent coming in, mortgage going out, and whatever's left is profit. Except that's not how it works. Once you factor in maintenance, property taxes, insurance, and the months where the unit sits empty with no tenant at all, Jake's real net cash flow is far thinner than what his napkin promised him. In year 1 alone, Jake replaces a water heater, patches a roof leak after a storm, and spends 3 weeks with the unit sitting empty between tenants. 3 weeks of mortgage payments with 0 rent coming in to cover them. None of that showed up on the napkin. The napkin only had 2 numbers on it. Real life has a dozen. This is the trap almost every first-time landlord falls into. They price their success off gross rent, not what actually survives after every bill is paid. Marcus, meanwhile, has none of these surprises. His biggest maintenance event of the year is spending 4 minutes logging into his brokerage account to confirm his automatic contribution went through. There's no leaking roof, no vacancy, no tenant who stops answering his calls. His portfolio doesn't call him at midnight. But Marcus has his own quiet struggle, not with the logistics, but with patience. When the market dips 15% in a single month, his number on the screen drops too. And unlike Jake, he can't drive by his investment and reassure himself that it's still standing. All he has is a chart and the discipline not to touch it. There's a strange psychological asymmetry here worth pointing out. Jake's stress is loud and immediate. A phone call, a leak, a missed payment, but it's also finite. He fixes the problem and it's over. Marcus's stress is quiet and constant. A red number that sits there for weeks, sometimes months, doing nothing but existing, tempting him to check it one more time before bed. Neither kind of stress is easier. They're just different shapes of the same 20-year commitment. By the end of year 1, Jake has learned to keep a repair fund on the side, a lesson his napkin math never taught him. Marcus has learned to stop checking his account every single day, because watching a long-term investment daily only makes the short-term noise feel bigger than it actually is. Fast forward a decade and something interesting happens. Both Jake and Marcus arrive at a similar net worth. On paper, it looks like a tie, but look closer and the picture is completely different. Jake's entire net worth is sitting inside one single property, one roof, one neighborhood, one market. And getting there took real ongoing labor, screening tenants, handling repairs, staying on top of paperwork. He's replaced 2 water heaters by now, repainted the unit twice between tenants, and spent one entire weekend arguing with a contractor over a plumbing bill that came in almost double the original quote. He's learned more about local rental law than he ever wanted to know, mostly because one tenant stopped paying and he had to figure out in real time what he was legally allowed to do about it. Marcus's net worth, meanwhile, is spread across hundreds of companies in a single fund, and he's put in 0 hours of work to get there. He didn't have to research which sector to bet on, didn't have to time when to buy or sell, didn't have to interview a single company's management team. He set up an automatic transfer once, a decade ago, and mostly forgot about it. Except for the part where he watched the number slowly climb every time he checked. Same finish line at year 10. Completely different route to get there. And here's what's easy to miss. Jake's 10 years also came with something Marcus never had to think about: concentration risk. If that one neighborhood declines, if that one local employer shuts its doors, if that one property needs a new roof at the worst possible time, Jake's entire net worth feels it directly. Marcus's hundreds of companies spread that risk so thin that no single bad year at any one business meaningfully dents his total. There's also a time cost buried in Jake's version of the story that never shows up in a net worth number. Conservative estimates put a self-managed rental property at somewhere between 5 and 10 hours a month once you count tenant communication, bookkeeping, coordinating repairs, and the occasional emergency. Over 10 years, that's well over 1,000 hours, the equivalent of 6 months of full-time work spent keeping that one asset running. Marcus's 1,000 hours over the same decade were spent doing whatever he wanted, because the only labor his strategy required was clicking confirm on a recurring transfer once and never touching it again. None of that means Jake made a mistake. Plenty of people would happily trade 1,000 hours of hands-on work for the extra control, the tax advantages, and the tangible asset sitting under that leverage. But it's a real cost, and pretending it doesn't exist is exactly how people end up disappointed with the strategy that was never actually free of trade-offs in the first place. Now jump to year 20. Both investors land somewhere between $400,000 and $500,000 in net worth. Same ballpark. Almost like they planned it that way. But the story behind those numbers couldn't be more different. Jake worked for every dollar of his equity. Years of active management, decisions, and risk. He's had 5 different tenants over 2 decades. He's fired one contractor and hired another after getting burned. He's raised the rent 4 times, each time nervously wondering if the current tenant would leave. He's paid off a good chunk of the mortgage, and what's left of the loan balance keeps shrinking every single month, quietly building his equity even in years when the market for that particular neighborhood barely moved. That's the part of leverage people forget to mention. Someone else's rent check has spent 20 years paying down Jake's loan for him. It isn't just the property appreciating. It's the mortgage itself disappearing, paid off dollar by dollar by his tenants. Marcus got there through nothing but compound growth quietly working in the background, like a snowball that starts small at the top of a hill and just keeps gathering size on its own, with no one pushing it. Every month for 20 years, that $300 contribution landed in the same account, buying a tiny sliver of hundreds of businesses without him ever having to think about which one, in the bad years. and there were a few genuinely bad years in there, the number on the screen dropped, sometimes by a lot. And Marcus did the single hardest thing an investor can do. Absolutely nothing. He didn't sell, he didn't panic, he just let the automatic contribution keep firing every month, buying more shares while prices were down, and rode the recovery back up without ever making a single active decision. So does that mean it's a draw? Not exactly, because each path has strengths the other simply doesn't have. Real estate gives Jake leverage, controlling a $250,000 asset with only $50,000 down, a 5-to-1 ratio most stock investors never get. Nobody hands you a 5 times loan to buy index funds on margin at a reasonable rate the way a bank will hand you a mortgage to buy a house. That leverage cuts both ways. It can multiply gains, but it can just as easily multiply losses if the property loses value. But for Jake, over 20 years in a market that generally trended upward, it worked in his favor. It gives him tax shelters through depreciation, letting him write off a portion of the property's value against his rental income every single year, even while the property itself is quietly appreciating in the background. And it gives him the option to roll gains into a bigger property tax-free through a 1031 exchange, deferring the tax bill indefinitely as long as he keeps trading up instead of cashing out. Real estate also gives Jake a kind of forced savings discipline that Marcus never had to build for himself. Jake couldn't skip a mortgage payment on a whim the way someone might skip a monthly brokerage contribution during a tight month. The bank and the risk of losing the property kept him consistent whether he felt motivated or not. Index funds give Marcus something Jake never had: liquidity, the ability to cash out instantly if life demands it, zero management stress, and a scaling strategy as simple as increasing his monthly contribution. If Marcus needed $10,000 for an emergency, he could sell a portion of his index fund and have the cash in his account within a couple of business days. Jake can't sell a portion of a house. If he needs cash, his only real options are refinancing, taking out a home equity loan, or selling the entire property, and none of those happen in a couple of days. No negotiations, no contractors, no 2 a.m. phone calls. Marcus never had to learn the difference between a load-bearing wall and a cosmetic one. He never had to sit across a table from a tenant explaining why the rent was going up. He never had a single Sunday afternoon ruined by an emergency repair call. There's also the diversification angle worth sitting with for a second. Jake's success or failure over 20 years depended heavily on one specific local market: its job growth, its population trends, its school district reputation, even its crime statistics. Marcus's success depended on hundreds of businesses across dozens of industries and countries all growing at once, which is a much harder bet to lose entirely, even if it's also a much harder story to tell at a dinner party. Scalability looks different for each of them too. For Jake to double his real estate exposure, he needs another down payment, another mortgage approval, another property to manage, another set of tenants to screen, an entirely new operation stacked on top of the first one. For Marcos, scaling up means changing one number in a settings page. Raise the monthly contribution from $300 to $500, and the same automated system does the rest without a single extra phone call. And then there's the failure mode each strategy is most vulnerable to, which almost never makes it into the highlight reel. For Jake, it's a bad tenant combined with the slow local market at the same time. Vacancy eating into cash flow right when the property itself isn't appreciating either, leaving him covering the mortgage out of pocket for months on end. For Marcus, it's a prolonged downturn arriving right before he needs the money, forcing him to sell low simply because the timing of his life didn't line up with the timing of the market. Both risks are real. Both are manageable with planning. Neither one shows up on the napkin. So here's the real question this leaves us with. If $50,000 gets you to the same place either way, what happens if you don't have $50,000 to begin with? What if all you have is $500 a month? No down payment, no bank willing to hand you a mortgage, no 5-to-1 leverage waiting for you on day one. Just a few $100s you could realistically set aside month after month, starting from exactly zero. That path looks completely different, and it's exactly what we're breaking down in next week's video. Waiting 5 years to invest cost one person $500,000. Here's the real conclusion from Jake and Marcus's 20 years. Neither strategy is better. One built wealth through labor, leverage, and a property he could touch. The other built the exact same wealth through patience, automation, and a number he mostly ignored. Both of them ended up in roughly the same place, and both of them would probably tell you their path was the right one for them. The real trap is picking one without running the actual numbers for your own life, your time, your stress tolerance, your risk appetite. Some people would thrive doing exactly what Jake did. They'd enjoy the hands-on control, the tax advantages, the feeling of building something tangible brick by brick. Other people would burn out after the very first vacancy or the very first 2 a.m. phone call, and for them, Marcus's boring automated path is the only one that actually gets finished. If you've made it this far into a video about napkin math and net cash flow, that tells me you're not most people. Most viewers would have clicked away by now looking for a shortcut, a hack, a guaranteed answer. But you're still here, which tells me you're the kind of person who wants the real numbers before making a decision that could shape the next 20 years of your life. So subscribe to Fiscal Sensei now, because every week we run real numbers like this one to help you make decisions with your eyes open, not just your gut. Tell me in the comments, after seeing this math, would you rather be Jake or Marcus? I read every comment. And before you go, hit subscribe, because next week we're breaking down how waiting 5 years to invest cost one person $500,000. At the end of the day, wealth isn't built by picking the one correct investment. It's built by choosing a path you can actually live with for 20 straight years. Financially, mentally, and in terms of your time. Jake's path demanded his weekends, his patience with tenants, and a willingness to handle problems most people would rather pay someone else to avoid. Marcus's path demanded something quieter but just as difficult. The discipline to keep contributing every single month, especially during the years when the market gave him every reason to stop. Neither of them got rich overnight. Neither of them found a secret formula. They both just picked a lane, stayed in it for 2 decades, and let either their labor or their patience do the compounding for them. That's really the whole lesson hiding inside this comparison. The specific vehicle matters less than most people think. What matters is whether you can actually stick with it long enough for the math to catch up to your effort. 20 years is a long time. Long enough for a strategy that looks perfect on a spreadsheet in year 1 to fall apart by year 3 simply because it didn't fit the person trying to run it. The investor who quits in year 3, whether that's a landlord who sells the property in frustration after one bad tenant, or an index fund investor who panics and cashes out during a downturn, never gets to see the version of the math we walked through today. The compounding, the equity paydown, the tax advantages, none of it has time to work if the person holding the asset gives up halfway through. So before you decide which one of these two men you'd rather be, ask yourself a more useful question first. Not which strategy performs better on paper, but which one you could realistically still be doing without resentment 20 years from now. That answer will tell you more about your own path to $500,000 than any spreadsheet ever could. This has been Fiscal Sensei. See you in the next one.